Okay. There we go. All right, very good. So I'll start with my intro and then your intro. Okay. Okay. Welcome to the Potting Shed. I'm Mariann Montagne with Mosaic Consulting. And today we're asking the question, so what exactly is a common stock and what's that all about? And to answer that, we have a very special guest and very, very qualified to answer your questions for you. And her name is Jennifer Martin. She is a portfolio specialist and a portfolio consultant based in San Diego. Welcome to the Potting Shed, Jen.
Thanks so much, Mariann. Nice to be here.
So let's just start at the basics. Number one question, what is a common stock?
Sure. That's, it's actually a really fun tool for investing. It's where you get to go and buy a share of ownership in a company. And it can be a large company, a mid-sized company, a small company that's publicly listed on an exchange. So usually you'll typically go to a broker and use them to execute a trade to invest in the company.
Okay, so are there private stocks too?
There are. You access them a little bit differently, and liquidity isn't quite as good as it is on publicly traded equity. The publicly traded equity, you can go into an exchange and they change hands every minute, multiple times a minute. And you can easily find a price on those securities listed on the exchange. For private ones, though, you have to go through a special broker. And a lot of times it's an over-the-counter purchase, and there's not always a readily available price. And in a lot of those instances, maybe a large portion of those shares are privately held by someone who doesn't want to sell them. So they can be much more difficult to access.
Okay. So basically you're saying that you're buying into a partnership. Is that right?
Yeah, it's actually a really cool idea where you get to invest in a company, you get a share of that company, and you get to share in the profits of that company.
Okay.
On the flip side, though, there can be some risk. So if the company does have losses, you're not necessarily going to see any profits, whether that's via no dividend paid or your stock price goes down. So there is some risk involved with investing in these types of securities.
Okay, and some shares, I think most shares have voting rights. So why are voting rights important?
Voting rights are definitely important, and some companies have multiple share classes of common stock, where some have voting rights and some don't. So when you're purchasing a security and you're purchasing these equity shares through your brokerage firm, it's important to know what kind of shares you're buying. Do they have voting rights? These voting rights are really important because it allows you to vote for the board that controls this company. So this is a neat place where you can really voice your opinion and voice what you think is important. Is it important to you that these candidates have certain values that are important to you? Are they interested in protecting the environment? Are they interested in protecting equality, whether it be race or gender, and making sure that pays equal across those areas? Is it important that this company try to grow? And what are these candidates really looking to do with the business? So this is your chance to voice your opinion on what happens with the company. So when you do have voting rights, you're notified when there is a vote to be held, and you get to cast your votes. So definitely pay attention to whether your stock has voting rights. And if that's something that's important to you, definitely make sure you get the ones that have that, and definitely make sure to cast your vote when those ballots come out.
Okay, so some of the companies I'm familiar with that have two classes, voting and non-voting, are Berkshire Hathaway, the big one.
Yep.
Alphabet, that's another big one.
Yep.
And third is Brown-Forman, the distiller. But it also used to be that Ford Motor Company had voting rights only for the Ford family members. So that you can see that too in some companies.
Yes, you can. And again, I think in those situations, it's, it comes back to those share classes that are available to the general public. In some cases, like you were saying with the Ford Motor Company, they've opted to keep those rights to vote for board members within the family, or maybe there's share classes that are available only for people of a certain level within the company. So they want to keep those decisions in-house for whatever reason. So definitely something to be aware of when you're doing your screening with your brokers and looking at those equity common stocks that you're looking to buy.
Okay, and I looked at the chart for Brown-Forman A and B shares recently, and you can see over time that the ones with voting rights sell at a different rate than the ones without voting rights.
Which is also something that companies are able to do, right? They're able to make these decisions about their common equity and whether they want to price them differently when they first do an offering, and whether the market also sees that it's a benefit, a premium benefit to own a certain share class. In some cases, people may really value that at a high level to be able to have that right to vote.
Okay. So speaking of where shareholders rank, let's talk about where they rank versus bondholders and preferred shareholders, and why that matters in certain situations.
Sure. So when it comes time to ranking, and in terms of ranking, we're talking about who has the right to see those profits first and so forth, and then also in a bankruptcy situation, right? So in the situation of seeing profits, preferred equity holders tend to be paid first in terms of profits. So they will see their dividends paid out before any of those profits make it down to the common stockholders. So the preferred holders will oftentimes see a set dividend rate, whereas with common stockholders, you'll see a variable rate. That rate will fluctuate based upon what the profits are and how much of those profits were paid out to the preferred holders first. And then also in a bankruptcy situation, who gets paid first is the bond holders. So the debt holders, they're paid first. Up next would be your preferred stockholders, and then finally would be your common stockholders. So as a common stockholder, you do have some risks involved with, in a bankruptcy situation, not coming out great. So in some situations where maybe things were pretty dire for the company, you may actually see your value go to zero.
Okay, that's very important to realize. And in the company's financial statements, where can I find common stock or shareholders' equity listed?
Sure, you usually find that on the balance sheet under shareholder equity. And in some cases, you'll actually see it broken out between preferred, common stock. You may see different share classes listed out there specifically, but you can find it on your balance sheet.
Okay.
So when you're running your screens and looking at data through your brokerage firm, which should be available to you, you can oftentimes pull up a publicly traded company's balance sheet, and you can look at it there.
Okay. And then, yeah, let's go back to discussing liquidity again.
Sure.
Public stock versus the private stock. Can you go into that a little more?
Sure. When it comes to liquidity between common stock and private stock, there's definitely some differences. Common stock is publicly traded. It's listed on an exchange, and for really large companies, say like Alphabet, the stock it trades hands every minute, multiple times per minute, and you can easily find a price that's quoted with those trades. Again, all of that's public information. It's all on exchanges and very easily accessible. So if you wanted to buy shares in that company, it'd be really, really easy for your broker to execute those trades for you. Or if you needed to sell your shares, it'd be very, very easy for you to liquidate them. Versus the private shares are going to be a little bit more difficult to trade. They're usually traded over the counter through a broker. And a lot of times there's not a lot of supply and demand of these shares. So if you're looking to buy shares of a privately held company, you may find that no one wants to sell any of their shares. Maybe the family is holding on to a large portion or maybe almost all of the shares, and they're not looking to sell any. They're not looking for any outside investors at the time. Or maybe you hold some and you're looking to maybe trim your position or sell some shares, maybe all your shares. And you find that there's not a big market for someone wanting to buy shares in that company. So you do have a little bit more limits, definitely more challenging time buying and selling in the privately held space.
Okay, and let's turn to dividends for a moment. Do all common stocks pay dividends?
They don't. There is nothing that says that common stocks have to pay dividends. There can be situations where a company has a great year, their earnings have been amazing, their profits are looking great, but the company says, hey, we're actually going to keep that profit and we're going to use it to grow our business. So maybe that year they choose to skip paying out a dividend completely. In other cases, the company might say, hey, we had a great year. We're good where we are right now. We're not looking to grow the company a lot. So let's pay our shareholders a dividend for investing in the company. Let's pay them some of that profit. So it's up to the company whether they want to pay one or not on common stock.
Okay, so it's not fixed, any dividends, they're not guaranteed.
They are not. And it's all based upon the profits of the company for that year. So one year the company may have an amazing year and they say, we're gonna pay out a really nice dividend to our shareholders. We've had a great year. Let's share some of that profit with them. But maybe the next year, their profits aren't as great. They still want to pay a dividend out to their shareholders, but maybe it's not as big because they didn't have as much in terms of profits that year. Or alternatively, maybe they decided to keep some of it because they want to make an acquisition. So they've kept more of that profit internally to grow the business instead of paying it out. So maybe your dividend's smaller for that reason. So it's at the discretion of the company for common stock, whether they're gonna pay a dividend and how much that dividend's gonna be.
Okay, but how can I tell if the company can continue to pay its dividend?
I think there's a handful of ways you can do that. And I think one of them is, what's the company done historically? Is this a company that traditionally has been paying out a steady dividend? And you can see that when you're doing your research on your stocks, you can see whether the company has historically paid out a dividend, and you can see what that dividend is. Alternatively, you can see if the company has not paid a dividend. Have they been more in a growth mode? So I think while past performance is not an indicator for future returns, it does, in this case, a lot of times show how the company is run and managed and whether they're going to pay a dividend or not. You can look at the financials for the company. Is the company in a good financial state? Is it in a healthy financial state? Is it profitable? And if it is, even if they haven't paid a dividend for the last couple of years, if the financials are looking good, it definitely increases your chances of them wanting to pay out a dividend to their shareholders because they have the money to do it.
Okay, so one of the sources I use to see what the company's history on dividends has been is just going www.nasdaq.com. And then I believe it's along the left side, you have a dividend history tab, and you can put in the stock ticker of a company that you're interested in and see what they've done. And I'll also note that, during COVID, when there was a lot of uncertainty in the markets, there were a lot of companies that skipped a dividend, right?
Yeah, and that makes sense from a financial standpoint. If with there being so much economic uncertainty during those times, you don't know what's coming next. You don't know, supply chain issues were a problem. People spending money, people stop spending money, so your profits are less and you're not sure what the next year is going to hold. It was kind of a question mark. We were all kind of in a holding pattern. So I think a lot of companies were conservative, and rightfully so, in holding on to that cash instead of distributing it just in case. Okay. Just in case something happened and things didn't, turn back to normal. It was a good financial buffer for them.
So it wasn't a mistake or a bad mark against any company that skipped during such stressful times.
Definitely not. It's, I think it was probably a smart decision. And again, as a common stockholder, you run the risk of some years getting a dividend and some years not. And as a common stockholder, you want to see your company succeed. You want to see it be successful because then you're going to profit from that as well. So if that's what the company needed to do to get through that, turbulent time, then you trust the management, you trust the board to do what's right financially for the company, because you're going to benefit from that too.
Okay. And just, it's like September 1st, 2023. Can you give us a snapshot of what the dividend yield looks like for the S&P 500, the big index for US stocks?
Sure. It was looking at about 1.44% towards the end of August. And that's a decent dividend to be paid on your common stock. And markets have been doing quite well. So hopefully that equity that you've built in your position has gone up too. So to see a nice little dividend on top of stocks doing well, I think has been a plus.
Okay, so going back to how you buy common stocks, you talked about going to an online brokerage account and putting in a trade request and executing almost immediately. But what if your company isn't based in the US? How do you buy international common stocks?
Sure. International common stocks, a lot of times to access locally traded shares. So for example, if it's a company, a Japanese company, and you want to access local shares that are based in Japan, institutional investors have the ability to open up local accounts that allow them to hold and trade those local shares that are traded directly on those exchanges. For retail investors like you and I, we would essentially go and access those shares via something called an American depository receipt, so an ADR. Those ADRs are typically listed and traded on a US stock exchange. And it's basically an American depository receipt. So a bank will hold the shares, the local shares of that stock, and you're buying the receipt for those shares. So you go and buy one ADR of a Japanese security. You now hold one share of that stock through this depository receipt that another bank will hold. You'd still see most of the times on ADRs, I typically see dividends being paid. Not all the time, but most of the time, and when they are paid, they're paid out in US dollars, which is great. But it gives you access to these foreign markets and shares of these stocks that are traded on foreign markets that maybe you wouldn't otherwise have access to.
So those same ADRs can be traded just like US companies through those same accounts.
Yep, exactly. So from my experience, you see this more in larger size companies versus some of the smaller companies. So you typically have access to the larger type of corporations and their common stock versus the smaller ones. Some of these programs can be a little bit expensive if they don't have a lot of shares or a lot of activity in them or a lot of interest in them. So again, it's typically the larger companies that I see these in.
Okay. And what's the minimum investment in a stock?
There is one lot. So for some companies, one lot equals one share. For other companies, Japanese securities, for example, if I was buying them locally, they trade in 100 share lots. So I would have to buy 100 shares in order to purchase into that equity. But for US listed securities, it's typically one share. So the amount of money you have to spend depends on the share price. So if I were to go buy one share of a company whose share price is really high, it's going to cost me a lot of money to go and buy that one share to get into that position. Versus a company that has a lower price stock, it's going to cost me less money and maybe I can buy more shares of it.
Okay. And when a company sells new or additional shares, what are the proceeds used for?
Companies will often do a secondary offering or list new shares when they want to maybe go through some growth for their company. Maybe they want to buy or build a new manufacturing facility, or maybe they want to acquire another company. So by selling these shares and equity in the company, they're raising money. They now have that cash that they can go and do something with, maybe to grow the business. Maybe they want to get into a new line within the company, a new product. So they can use that to get that started. And they can also use it to pay off debt. if that's something that they're looking to do. It's a way to finance paying down some of that debt.
Okay. That's what I was curious about. And so when they issue new shares or have a secondary offering, then what happens to the value of existing shares?
It typically dilutes them. So you now have more shareholders holding equity. And if you're already an equity holder, you tend to see the stock price dip when that happens. Not all the time, but typically you see a little bit of a dilution factor as a existing equity holder. That being said, you hope that the company is doing something good with this capital that they're raising. So maybe they're going to do, again, go into growth mode and do something great that's going to grow the company. So maybe temporarily you see that dilution hit your portfolio. The hope is that that's going to actually come back to you once they do get through that growth period in that phase, and that growth is something that's positive for the company. So your stock value goes up and maybe your dividend payments go up as well. Okay.
So a secondary may be an opportunity to add to the company stock that you already have.
Yeah, so not all offerings are the same, but a lot of secondary offerings will first go to institutional investors who are looking to purchase a large amount of shares in that offering, so make a large investment in the company, and then furthermore it'll go down to individuals like us.
Okay. And now, how about the number of stocks anyone should hold?
I don't know personally for me that there's a certain number of stocks that you should hold, but I do believe in diversifying your portfolio. And in terms of diversification, it's really smart to hold a number of positions across a variety of different sectors and industries. So you don't want to put all your eggs in one basket, essentially. During the financial crisis, 2007, 2008, if you had all of your stocks in the financial sector, your portfolio was probably looking really, really, really bad. But conversely, if you've got some in, a variety of different areas and types of industries, chances are if that one sector gets hit really hard, maybe your other sectors kind of can offset that loss. So it prevents your portfolio from being weighted down too much in one area, so that if something from an economic standpoint really happens to that sector, good, bad, or otherwise, your portfolio is buffered a little bit. So it's spread out across different areas. Typically for me personally, I don't like to have more than 5% of my portfolio in any given one stock per se. That's my own personal guideline. I typically like to limit it to 5% of my investment goes into any one particular security. And I try to limit the amount I have in any given sector to about 20%. So I can kind of spread it across a bunch of different areas.
So you're saying about 20 stocks and no more than 20% in any one sector.
Correct. And the nice thing about having ADRs available to you as well is that you can do this on a country level as well. So if you're looking to do any sort of international exposure, you can say, I'm going to limit my portfolio to a maximum of, say, 20% per country, so that from an economic standpoint, as it's tied to different countries, you then have some protection there as well.
Okay. And here I'd like to point out that the US stock market represents only about 50% of the total global stock markets. So if you're putting everything into one country, the US, you're just limiting yourself from the half of the world's choices.
You really are. And I think, the world has become such a huge exchange. We buy goods from Japan all the time. We buy things from Europe all the time. My car's from Germany. But via ADRs, I'm allowed to access things like that, which is great for my portfolio because I can get access to the entire global economy and not just this little bubble that we live in here in the US.
All right. Now, the last thing I wanted to approach is exchange traded funds. And
sure.
Can you talk about the benefits and the downfalls of exchange traded funds as it relates to common stocks?
Sure. I think, exchange traded funds or ETFs are a great way to let someone else do the diversification for you. It's fantastic. You don't have to go and pick 50 to 60 stocks to invest in. And especially if it's an international exchange traded fund, you don't have to go and figure out, 50 plus companies to invest in across the globe. Someone else does that for you. Most exchange traded funds do have certain criteria they're following, diversification rules that they will limit themselves to, sort of like I was saying, maybe I do 5% in any given position, and then I'll do a maximum of 20% per sector and maybe 20% per country. So they'll have diversification rules like that they'll be following. But it's a great way to access a large portfolio that's decided for you. You don't have to figure out the diversification piece, and you get access to 50 plus companies. Usually is costing you $25 to $75 per ETF, which is great. But the risk is, if you hold an ETF that has maybe 100 plus stocks in it, your ownership gets diluted. So each one of those companies is going to represent a portion of your portfolio. But when that stock goes up, because there's so many stocks in there, you don't really feel that price movement. You don't feel it as much in your portfolio as if you had only held 25 securities. Same thing on the downside, though, is if that stock goes down big, you're not going to feel that loss as much. Right. So you might not feel the volatility in each of the securities as much. But again, you get that benefit of diversification done for you.
Okay, so there's a saying, rising tide lifts all boats. So you can use an ETF to benefit from a rising tide in some country or some sector of the market, and participate with a large number of companies, and hopefully you pick the right sector.
Sure. Yeah. There's ETFs that specialize in certain sectors, industries, countries, etc. Or you can find ones that are built to mirror, say, the S&P 500 that is across industries and sectors.
Across the whole US, right?
Yep.
Right. Okay. Well, I thank you very much for your time today. And
sure.
Please come back to the Potting Shed for more insights. This has been a great discussion. We love your expertise. And thanks again.
Thanks for having me. I appreciate it. Hope you have a great weekend.
Same to you. Now I'll
take care.
Drop you here, and I will say thanks so much for listening. If you have a question for the Potting Shed, no, I'll stop that. Thank you so much for listening. If you have a question for a future podcast, please email me at mmontagne@mosaicconsultingllc.net, and perhaps you can ask your question individually on the air, or you can remain anonymous, or maybe you can even join us in the Potting Shed. To subscribe, I hope you will subscribe to our podcast. I hope you will subscribe to our show in the Apple Podcast. There we go. That's done. Thank you very, very much.
Yeah, you're welcome. Happy to help you.
Yeah, this is great. And how's Andy doing today?
Finally better. He's kicked hand, foot, and mouth. Finally, it's gone.
Oh, good, good. And all the shedding has stopped.
Yeah, I think his big toenails might be falling off, but all good.
All good. It'll take
all good
6 months. Well, not even for a little kid, for a baby.
Yeah, exactly. It'll grow fast. So yeah, we'll see what happens. So when you coming back to San Diego?
Not sure, but hopefully soon. We were hoping to see them in Detroit for a wedding, but they couldn't make it all work. So bummer.
Gotcha.
Major bummer.
Yeah. Those trips end up being wild and crazy for them.
Yeah. Okay, you take care. Have a great weekend and a great
Thanks, Mariann.
Okay,
take care.
Now. You too.
Bye.